we've got a few other reporting issues to go over as well. The first one deals with what happens if we decide we're going to change one of our accounting principles. When we talk about accounting principles, I'm talking about something like, what if we decided instead of carrying our inventory at LIFO, we determined that FIFO was the better option. So we want to switch. We want to totally change an accounting principle. And that's a pretty big one to change. So how do we do that? Well, what you're going to have to do is, because it's a change of an entire accounting principle, you're going to have to figure out what would have happened if you had been doing this from, the start of your inventory or whenever you started with that accounting principle. So what you're going to have to do is you're going to have to redo all of the prior year's financials, or at least the prior year's income statements, on the same basis as what you're wanting to adopt. So if you're changing from LIFO to FIFO, you're going to have to go back and all those years, if it's been 10 years and you've been doing LIFO, you're going to have to redo all those 10 years statements to reflect the new FIFO, what you're wanting to change it to. And what's going to happen with how to balance all of this out, since you're redoing income statements, it's going to all go through retained earnings as your income always does. That's where we close it to. But what we're going to do is, the year that you're changing the accounting principle, that year you're going to adjust, you're going to put an adjusting entry in for the cumulative effect of that change, and it's going to adjust the beginning balance and retained earnings. We call this a retroactive restatement or a retroactive adjustment. You're going to make the adjustment now, but it's going to impact all of those previous years. You're going to redo those statements, and you're going to change the beginning balance of your retained earnings account to reflect that cumulative change. Another type of change you might have is a change in accounting estimate. So we're not talking about an accounting principle, but now we're talking about an accounting estimate. So some type of a, for instance, maybe your useful life of a piece of equipment. Okay, would be a change in accounting estimate. Some type of a, it's a normal correction, it's a normal adjustment. So that one, what we're going to do is going to be a little different. Let's say you had that piece of equipment, and originally, you bought it last year, and you thought it was going to have a 10-year useful life, but for whatever reason, you got to redo that estimate, and it's only going to have, it really should have only had an 8-year life. Well, it's been a year. So do we go back and look at it from last year? No, we're not going to do it like we did with the change in the accounting principle. We're going to just go forward with this one. So you make that change, but what you're going to do is you're going to move forward with the change. So you'll figure up, okay, it's already been a year, so we should have had 9 years in, the useful life. But now we're going to only have, now I forgot my example. I think, we're going to have 7 years left, a total of 8 years. I think that's what I said. So you're going to figure out how much going forward that would change your accounting estimate. So you're not going to do anything backwards. You're just going to move forward with the same accounting estimate. Errors. Alright, somebody made a boo-boo. So there's a mistake somewhere, an error, and we found it and figured it out. And it was, of course, not intentional. It was just a mistake. So we got to figure out what to do with that. Well, for an error, let's say we found it now, and it was an error that should have been, not done for last year. Let's say it was 3 years ago, and we've all of a sudden found an error. And what we're going to do is similar to the change in the accounting principle. We need to go back and fix the error whenever it occurred. So we're going to go back, however long that is, and we're going to fix the error and redo again those statements. We call this a prior period adjustment. Okay, so we want to fix that problem. We're going to restate those income statements just like we talked about before, and we're going to adjust this year for that difference of the error in our beginning retained earnings balance. So again, very similar to the treatment we did with the change in the accounting principle. Comprehensive income. Alright, well, you might be saying, we've got income already. We talked about net income. Isn't that comprehensive? We got everything in there, right? Well, almost everything. Okay, comprehensive income. Your net income is a part of comprehensive income, but there's a piece that we haven't talked about, and it's called other comprehensive income. Before that, you're right, it's net income. It's all those things we've seen on the income statement. But there are some things that bypass your income statement, and those are the things we put into this other comprehensive income. One that I usually think of deals with if you have any unrealized gains or losses on your available for sale securities. When we talk about investments, when we looked at those holding gains or losses, and they're unrealized, we don't put them to the income statement. So they bypass it. We still record them, but it gets taken to this other comprehensive income. So that's not listed on the income statement, but it's still there and it's still part of our accounts. So we're going to list it on with our comprehensive income. And we can not calculate, but we can make up or show our comprehensive income one of two ways. We can do it as a standalone statement, or we can do it as a combined statement. If you do it as a combined, so you have one statement for all of your income figures, it's going to start off and it looks like your net income statement, but we're going to call it statement of comprehensive income, and it'll flow just like your net income statement to begin with, but then you're going to have a line item that says other comprehensive income after the net income, and then you'll add them together and that'll give you comprehensive income. So it's kind of just a little add-on to the income statement. You change the name of it. The other way you can do this is to have two separate statements. So you still have your income statement, just like you have before, and then you'll have a second statement that you need to prepare, and we usually term that comprehensive income statement instead of statement of comprehensive income for whatever reason. And that one, you start off with net income, which you've previously shown in your statement, your income statement, and then you add other comprehensive income, add them together, and that's total comprehensive income. Stockholders' equity, right? You can present in addition to that comprehensive income statement, a lot of times you're also going to see a statement of stockholders' equity. So this gives you full details on all of the stockholders' equity accounts. So there'll be a column for each type of equity, and it'll show us the change in those accounts over the time frame or the period. So it'll have a beginning balance in each of them. It'll show how they increased or decreased, what those changes were for. So, for instance, you'll have retained earnings will have a column. You'll have a column for common stock, if you have common stock. Preferred stock, if you have preferred stock. Might have those additional paid-in capital accounts that are separate. Have a column for those. And then you'll also have a column for accumulated other comprehensive income, okay? Because it's a part of your equities. It bypasses the income statement, but it is a part of stockholders' equity and balance sheet. So you'll have a column for that. So we'll show where net income impacts those. You'll show other comprehensive income. You'll show what those are if you had some of those unrealized gains or losses that we talked about. So the stockholders' equity that you've seen before, that statement, looks similar, but now we've just added in a new column for that additional or accumulated other comprehensive income as well, because it makes up the total of the equity account. And you'll also see one extra line item on the balance sheet under retained earnings in the stockholders' equity section for that accumulated other comprehensive total.